Hello, guys. Welcome back. Hope you all are doing well with your studies. In this particular video, we are going to talk about bonds. Okay. So, previously, we talk about financial market, and if you talk about the bonds, so they are generally part of financial market. They belongs to capital market. Okay. So here in this particular video, we are going to talk about the basic introduction to bonds, basically what are bonds and what are the basic types of bonds. And there are so many terminologies which are generally associated with bonds. So we will discuss these particular ones so you can easily understand the bonds and features of bonds, right? So like coupon rate, we have redemption value, we have face value, place value, day count convention and all. Okay, so this is a basic video on bonds. Okay, so we will try to understand what are bonds and what are the basic features and how to invest in bonds and what are the key features for this particular one. So guys, whenever we talk about bonds, so first thing, it is part of debt market. They are also known as debt instruments. Debt means through these particular instruments, borrower can raise funds from the market. And if you talk about the participants, so it can be any bank, any company, any government, or state government, municipal governments. So they can issue these particular instruments. And if you talk about the investors, so it can be again same, any bank, financial institutions, or like government or the retail participants as well. Okay, so these are the instruments. These are, like, we can say these are written documents through which basically borrower, they generally raise funds for long term duration. Okay, so this duration is generally more than 1 year. It can be up to 30 years as well. Okay, so bonds are debt instruments. Basically, debt means, basically, by using these particular instruments, borrower, they generally raise funds from the market for long term duration. Okay, issued by debtors for raising funds. These are issued for a specific time duration or a specific period, and carry a fixed rate of interest payable periodically. Okay, so like whenever, like being an investor, if you want to invest in bonds, so you will get a fixed rate of interest over the period. Okay, whatever the maturity period of that particular instruments. So bond are transferable in nature. You can transfer, or even you can use bond as a collateral. Okay, so you can take loan, or even you can collateralize these particular security, and you can invest in different securities, or you can take a bond, you can use as a margin product for these particular one. So if you talk about the listing of bonds, that generally happen in primary market, and if you talk about the trading, so that generally happen in secondary market. So bond are transferable and traded means buying and selling in secondary market. So when any issuer who or debtor who generally raise funds through bond, they generally list through a primary market. There is a process that called NFO, new fund offer. We already discussed these particular terminologies in our previous videos. And after the listing, so these are traded in secondary market, or which means you can like, let's say if you want to invest in some existing bonds, so you can buy that particular bond from secondary market. Okay, so basic is like these are the financial instruments which is govern, like we do have a governing authority for these particular, most probably it is RBI. And through these particular instruments, the borrower, they generally raise fund for long term duration. They are basically long term instruments. So issuer of bond pay interest to a purchaser for using his money. Let's say if government of India need funds for 10 year to finance some project, like let's say some highway project or some other project, like it can be defense related, it can be infrastructure related and all. So they generally issue bonds in the market, and they promise, the government of India promised to pay this amount after this time duration at a fixed rate of interest, and they made a promise ki they'll pay this much of rate of interest on that particular instrument. Market value of bond may differ from the face value and keep changing. So market value is totally depend on the market factors, which are demand and supply. So what is the demand for that particular bonds? If there is a high demand, investor, like let's say investor are continuously investing in that particular bond, so the value of that particular bond will goes up. Okay, so market value or market price, that can be differ from your face value. Face value, whenever we talk about face value, it is the value, it is also known as par value. Okay, so which is mentioned on the face of that particular bond. Okay, so whenever you see, whenever you buy a bond, so there is a face value or par value mentioned on this particular documents. It can be like rupees 100. Okay, so this is face value, but market value can be 90 rupees or it can be 110 rupees, because that totally depend on the trading cycles. Okay, so hope with this particular one, bonds is clear to all of you. So basic two three things you need to remember, that is bonds are debt instruments basically used for long term period. Long term period can be like the maturity of bond can be 1 year, 10 years, 15 years, 20 years, or it can be up to 30 years, which are generally known as deep discounted bond. We'll come to these particular points. So basically issuer or the debtor, those who generally issuing these particular bonds, they are raising funds for that particular, for a specific time duration, and they are in return, like those who investing in this particular bonds, they are getting interest at a fixed rate of interest. Okay, so now there are so many terminologies which are generally associated with bonds, so we will discuss these particular one by one. Okay, so first one, coupon rate. So what is coupon rate? Coupon rate is nothing, it is, you can relate with the rate of interest. Like whenever you invest in some securities, so you ask for the rate of return or rate of interest. So similarly, when we invest in bonds, so we use a rate of interest as a coupon rate. Okay, so a bond carries some specific rate of interest, which is called coupon rate. Okay, let's say there is a bond which is issued by government of India. Okay, and the coupon rate is 8% per annum. So this is rate of interest, or in bond language it is generally known as coupon rate. And here you can see the formula, because like some, as earlier we mentioned, like market price is different from your par value or face value. So that is generally calculated on the basis of this particular formula, that is total annual coupon payment divided by par value of bonds multiply 100. Okay, so that is the outcome is your coupon rate for that particular XYZ bond. Next one is maturity. So I hope you know this particular term. This is very simple. So maturity is a bond is issued for a specified period of time. Okay, so let's say government of India issued a bond for a period of 10 years. So 10-year is the maturity period for this particular bond. Any XYZ company, they issue a bond for a period of, let's say, 30 years. Okay, so 30-year is the maturity of this particular bond. Okay, so it can be short term, like ultra short term in case of bonds. Ultra short term bonds are generally long term debt instruments. So ultra short term, that is 1 year to 3 years. Medium, 4 to 10 years. Usually you will find bonds up to 10 to 15 years. Okay, and long terms, that is more than 10 years. But whenever you talk about the maturity, it is the completion or the time period after which investor they'll get their money return. Okay, so maturity is, which is specified on the face of that particular bonds. Yeah, after this particular specific time duration, you will get your money back. Okay, so that is called maturity. Next one, redemption value. So redemption value is, let's say there is an investor who invested 10 lakh rupees in bonds. After the maturity was 10 years. After 10 years, the coupon rate or the overall income from that particular bonds was supposed that 3 lakh. So 3 lakh, 10 lakh plus 3 lakh, 13 lakh will be the redemption value for that particular bond. Okay. So the value which the shareholder get on maturity is called redemption value. So it include principal plus interest or coupon on that particular one. So principal was supposed that 10 lakh rupees, and he got 3 lakh rupees interest after maturity. So 13 lakh will be redemption value for this XYZ bond in case of Mr. A. Okay. So this is again very simple one. Next one, face value. So this is very important one. So many times examiner they generally ask this question, or even if you want to understand bond or whenever you invest in bonds, you will find this particular term. Okay. So face value, which is generally mentioned on the face of that particular bond. Okay. So let's say there is a bond issued by government of India. So you'll find the face value of this XYZ bond is rupees 100. Suppose that. Okay. So the face value of this bond is 100 rupees. And now you'll find one another term, place value. So like let's say place value, you want to invest in 5 unit. So place value will be 5. So 100 into 5, your investment will be 500 in that particular case. Okay. Or even we have different lots and all. So it is also known as par value. So par value, which is stated on the face of that particular bond. Okay. Which is like you will find government of India, so the notary sign, and the face value is 100 rupees in this particular case, suppose that. Okay. It represents the amount borrowed by the firm which it promised to repay after a specific period of time. So there is an instrument or there is a bond which is issued by, suppose that, TCS. So TCS they made a promise, the face value of this bond is 100 rupees, and they'll pay at the rate of 8% per annum for the maturity period is, suppose that, 10 years. So this is called your place value, sorry, face value, or par value. This is your coupon rate, and this is your maturity period in case of that particular bond. Hope this is clear. Face value and place value. Place value is basically in multiple of. Okay, let's say if place value is 5, so your investment will be 100 into 5. So in multiple of 5. Okay, next point we are going to cover, that is place value. So place value, it can be like 2, 5, 4, 8, 6. So here let's say your place value is, suppose that, 5, and so it is in multiple of. So your face value was 5 and place value was 5 into 1000. You purchase 1000 unit of that particular one. So your place value will be 5000 for that particular instruments. So place value is defined as a digit multiplied whenever it is placed either by 100 or thousands. So it can be like, if it is 100, so it is 500. If it is 1000, it will be 5000. So place value is basically what is the overall amount that is invested by investors in any XYZ bond. Okay. So Mr. X, suppose that this is the case of Mr. X who invested 1000 unit, and the face value of that particular bond, which is stated on the face of this particular bond, was 5 rupees. So it is 5 into 1000. Okay. If the place value is 100, so it will be 500 only. Okay. So again, very simple one. Next one is market value. So market value generally it is based on the factor prices or market factors which are demand and supply. Okay. So face value, or we can say market value, can be differ from the face value. Let's say face value of a bond is 100 rupees. So market value can be it can be 110, it can be 95 rupees, or any other. So that totally depend on the performance of that particular bond. So a bond traded on a stock exchange, traded means you can buy or sell that particular security on a stock exchange like BSE, NSE. Market value is the price at which the bond usually bought or sold in the stock exchanges. Okay. So which means that is totally depend on the investors expectations. Okay. So let's say the face value of that particular bond was rupees 100, and the market price, the current market price, seller side and buyer side. So let's say seller side it is 110, and buyer side it is 108. So let's say after some time there is an investor who buy this particular one in 109 rupees. So this is the market price for this particular bond. So last trade price, or you can say market value or market price. So market price can be different from the your face value or par value. So how you will calculate the entire market value? So the number of buyers, number of sellers. Okay, so in that particular XYZ fund or in XYZ bonds. But here, let's say they issue 1000 unit at the rate of 100, so that will be their face value. But here 109 into then 1000 units, so that will be the outcome will be the market value of that particular bond. So market value can differ from the face value of that particular bond. So market value may different from the par value or the redemption value of that particular bond, so which already discussed. Hope this is clear. Now day count convention, again this is very important one. So day count convention is, let's say there is an investor who invested money as on 2nd of February 2023. Okay, so he invested in market on 2nd of February 2023. Okay, and he redeemed this particular money on suppose that it is August 15, 2023. So now how we will calculate the interest rate for this particular investment? So we do have different methods. So they are generally known as day count convention. Okay, so it can be like 30 365. It can be like where we are generally assuming a month as a 30 days. It can be like 365, which means we are calculating each and every day, 2nd February to 15 days. Let's say it is 45 or 85 days. Okay, so we will pay the rate of interest for 85 days only. So that is day count conventions. Okay, so interest payment are made based on the day count method which is followed. So we do have different one. Like first one is actual means he invested on 2nd February and he redeemed on 15th of August. Okay, so let's say in between the total number of days are, let's say 85 or 90 days. So we will pay the rate of interest for these 90 days only. Okay, that is called actual. So 365. Actual 365. So where we are assuming the year, the number of days in a year is 365 days. So where even in case of a leap year, days in the year would be considered as 365 days. Okay, so we will not adjust this leap year, so we are calculating days in a year as a 365 days. Okay, then we have actual 360. So where we are assuming days in a year are 360, and so that is generally known as actual 360. Then we have 360, as I earlier told you. So we are calculating the months, or the days in a months are 30. Okay, so that generally known as 360. So basically guys, day count convention are nothing. It is like it is generally used for the redemption purpose. So whenever we make payouts, so we use different. It can be actual, it can be actual 360, or it can be 360. It is generally mentioned in the documents of the bonds. Whenever you purchase some bonds, so if you study the features of that particular bond, so you will find this particular day count convention as well. So hope this is clear to all of you. Now next, these were some major terminologies or some basic terminologies which are generally involved in bonds, or they are generally very close to bonds. So to understand this bonds, or whenever you study the bond valuation, whenever you calculate the yield to maturity, okay, so you need to understand these particular features. Okay, so when we'll do the calculation part, so you need to remember these particular ones, because they are very important to use the concepts regarding the calculation of YTM. Okay, now types of bonds. Types of bonds are nothing like we have different type of issuers. Like some bonds are issued by Government of India. They called sovereign bonds. There are some bonds which are generally issued by state government, some municipal government, so municipal bonds. Okay, there are some bonds which are related to inflation. Okay, to protect the interest of investors from inflation. So we have inflation index bond. Okay, so we have different issuers, or we have different features of bonds. On the basis of these particular bonds, they are like we have different categories as well. So bond are often divided into different categories, like tax saving, We have credit quality, issuer bonds, maturity, inflation covered, secured, unsecured, and all. So I'll show you a list. In our next video, we will discuss the detail of bonds, like detailed type of bonds. Like we have number of type of bonds, so we will discuss these particular bonds in a detailed manner. So we have fixed rate of interest, which means where the rate of interest is fixed. Let's say if you invest 1 lakh rupees, so your rate of interest is 8% per annum for 10 years. So every year you will get 10% rate, 8% rate of interest in this particular one. Another one is floating. Floating means variable. So where this rate of interest will vary. So we have different indices like LIBOR, MIBOR. So we use these particular indices to calculate the rate of interest for a specific time duration. Okay. So floating is where rate of interest are varies on yearly basis. Okay. Zero coupon bonds. So zero coupon bonds. So many time examiner ask question based on zero coupon bonds. So where if you see there is no assets rate of interest mentioned on these kind of bonds. So let's say the face value is 100 rupees, and at the time of investment basically they ask you to invest 90 rupees only. So they'll say you invest 90 rupees, after 1 year we'll give you 100 rupees. So where there is no rate of interest is mentioned or there is no coupon rate is mentioned, so these kind of bonds are generally known as zero coupon bond. Okay, where no coupon rate is mentioned. So but the logic is you invest 90 rupees, after 1 year will give you 100 rupees. So you are getting rate of interest, but there is as such no rate of interest mentioned. Okay, inflation linked bonds, basically these are like if there is a high inflation in the markets, which means the value of your domestic currency will goes down. So to protect the interest of investors, so there are some inflation index bonds. It can be like inflation, whatever the inflation, they use the formula of equal to or greater than. Then like we have let's say if there is a XYZ inflation bonds, this is an inflation bonds, where they mention whatever the inflation price they'll give you plus 2% rate of interest, which means if inflation goes to, let's say at the time of issuance inflation was 5%, now it become 15%. Okay, so in that particular case, to protect your real income, they'll give you 15 plus 2%, which is 17% rate of interest on this particular bond. And another case, if we do not have inflation bonds, let's say the rate of interest on this particular bond was 10%. Okay, but during this particular period, inflation increased by 15%. On an average, inflation in the economy was 15%. So if you calculate the real income, so real income formula is your rate of interest 10% minus 15%. So your investment will go in negative. Okay, so you do not make any money from that particular investment. So to protect these kind of activities in the market, we have inflation bond. We'll discuss these one in detail as well in our next video. Perpetual bonds, these are kind of shares. Subordinated, these are part of debt, but whenever any company go for the liquidation, so first these are not the first priority. Okay, first they pay the other debt, then they distribute the subordinated bonds debt. Okay, so these are risky in nature, we can say. Corporate bonds, these are issued by corporate houses. Okay, let's say TCS issue some bonds to raise fund for 10 years. So that is generally known as corporate bonds. Tax-free bonds, so basically these are green bond, infrastructure bonds. So government of India, they time to time release these kind of bonds, and they said like if you invest in these kind of bonds, you do not need to pay any taxes for that particular investment. Okay, so they are like exempt category bonds. Public sector bonds issued by government of India or government of like, public sector enterprises. Municipal, issued by municipal authorities, local authorities. State government, issued by state government. Central government, issued by central government, or we can say government of India. So on the basis of issuers, on the basis of the feature of that particular bond, we have different type of bonds. Okay, so guys, in this particular video we generally talk about the basics of bond, what is bond, and how the concept of bond work. Okay, so hope this is clear to all of you. Still, if you have any query, please do mention in comment section. And guys, one thing, like whenever you plan to study the debt market, so debt market means bond market. Okay, so you need to know about these particular features because these are very basic terms. to understand the bond valuation or the YTM concept as well. Okay, so whenever you go for the YTM calculation, so you will face, like you'll find there is a place value, there is a face value, there is a market value, there is a redemption value. Okay, so to understand those particular terms, you need to know about these particular features as well. So hope this is clear. In next video, we will talk about the different type of bonds in detail as well. Okay, so this is it. Thank you for watching this video, guys. Bye bye. Take care all. Have a nice day.